There is one more topic I want to cover briefly before we get into the tax analysis section of the investment model, and that is the tax rate on long-term capital gains. And the actual tax rate will also depend upon your ordinary income. So first of all, look at here. If you're an individual and if your income is between 0 and 47,000 and some change, well, you pay no capital gains tax. Or if it's between 47,000 and up to 518,900, you're in a 15% tax rate. And again, this is the rate that applies to the gain. And if you're making over 518,000, well, your tax rate on the gain is 20%. And then it has the other categories. So if you're married, filing jointly, here's the rates. If you're married, filing separately, it's these rates. All this should sound familiar to you. And then if head of household applies, these are the rates. Now, let's just look at a model here quickly and just to hopefully clarify this. So you and your wife make roughly $200,000 a year. Yes. And that alone will put you in a marginal tax rate of 22%. And the marginal tax rate is here. These are the federal tax rates for your income. So if you're making $200,000, married filing jointly 200, well, you're in the 22% tax bracket. You're in here, 22%. Okay, moving on. Now, you have bought some land and you've sold it, and you sold it for $10,000 more than you paid for it. Great. When you sold it, if you sold that property and held it for less than a year, it's taxed as ordinary income. There's no break on the income taxes. You must hold it for more than a year. So in this case, the short-term capital gain, the tax on the short-term capital gain would be $2,200. That is your 22% tax bracket. Okay, if you had waited until you had held the property for at least 1 year, you would fall into the long-term capital gain rate of 15%. So your taxes would be $1,500 on that $10,000 gain, saving you about $700. Okay, one more example quickly. Again, here is another example. You're single and you bought a building in Oklahoma for $200,000. So you sell the building for $300,000. You have netted a $10,000 profit, a gain from the original purchase price. Now again, you're single, you're making $80,000. What is the tax rate on that? Well, again, if you held it for less than a year, then the tax rate will be taxed as ordinary income, which is 22%. So you'd owe $22,000 on this $100,000 gain. Again, if you had waited to at least 1 year, if you had held the property for at least 1 year, you would fall into the long-term capital gain tax rate of 15%, and your taxes would be a total of $15,000, saving you $7,000. Okay, same thing as what we really talked about. Okay, I wanted you to be aware of that and how that works before we get into the tax analysis, which is what we're going to do right now.